G'day guys, Seeney here and welcome to another episode on the Australian Wealth Channel. And today we're going to be talking about the types of people that shouldn't invest in stocks. Okay, so before we get started, please make sure you leave a like on this video and subscribe to the channel. Really helps to get these videos out to more people. It's great for the YouTube algorithm. Now, I've got my trusty 0-cent iced water here. I know that Graham Stephan has a huge YouTube channel in the States. He's got his 20-cent iced coffee, but you just can't beat water. It's so much better. So without further ado, let's get started on the types of people that should not be investing in stocks, because it can be quite easy to lose money if you have the wrong kind of personality. So the first one that we're going to talk about is those people that are overly emotional. Now, the thing with stock market investing is that it requires a lot of discipline and patience, and you can't make rash decisions. Now, what happens to a lot of people, they invest in a stock and the stock goes down 20% and they panic and they sell out. Now, the thing is, why did you invest in that stock in the first place? The reason you should be investing in a stock is because you think over the long term that's going to appreciate in value. And the thing that drives that is great business results. So if you're investing in a company and it goes down 20%, you should be excited. You're getting those shares of that company at a cheaper price. Whenever I see a stock go down that I've done a lot of due diligence in, I know that they're going to perform really well in the future, I buy more because I'm getting the shares at a discount to what I thought was already an excellent price. So if you are someone that's overly emotional and panic sells, that's something you might want to work on or not be invested. Right, now the next kind of person that should not be investing is the person that's incredibly prone to FOMO, which is the fear of missing out. Now, there's a lot of people out there, they see a stock or a cryptocurrency or something that's absolutely going to the moon. We're seeing gains of like 10%, 20%, 50% a day, and it just goes and goes and goes. Now, the problem is, when you hear about these things, it's probably too late for you. And if you have FOMO and you jump in at literally any price, chances are you're going to hit the top of the market and you're going to be riding that all the way down. And the thing about these stocks is that when they go up really fast, they also go down really fast. So, you might be seeing a stock go up 20% every single day, and then before you know it, it's going down 20% a day, and you've lost 50%, 80% of your initial investment. Now, if you've done your due diligence and you know that this is a company that's going to be fantastic, they're going to grow massively in the future, then if you're seeing shares at an 80% discount, that's the time when you're buying. So if you're someone that's really prone to FOMO, then I don't know if you're quite the right person to be investing in the stock market, because you need to look at it from a longer term perspective. The next type of person that shouldn't be invested in the stock market is those kinds of folks that aren't interested in learning about companies. Now, what I'm talking about is those that are picking individual stocks and want to be trying to find the best stocks for the future. Now, the thing is, if you're not doing your research and you're not learning about new sectors and new things, it's going to be really hard for you to actually get this right. Now, if you just want to track a broad market index and, put $100 away every week, that's fantastic. There's not too much learning that really needs to go into that. But if you're someone that wants to pick individual stocks, then you really need to have a love of learning and really understand the sectors that you are investing in. Without this, it's going to be a surefire way for you to lose money, because the only way to know who the winners in the sectors and the stocks that you're choosing are is actually understanding that sector completely. The next type of person that shouldn't be investing is those that are not interested in putting in the time. Now, doing your due diligence in companies obviously takes a lot of research, and that means it's going to take a lot of time, reading annual reports, reading investor presentations, understanding what the vectors of growth are for companies in the future. There's a lot of different things which you have to know if this investment that you're going to make is going to be successful. Now, if you're not interested in putting in that time, then you're not going to see the returns and you're going to be disappointed because you won't see the gains that you were hoping for. However, if you are doing your research and you've looked into all these companies, you've read the financial reports, you can see they have a great balance sheet, all of these different factors, then that's where you're going to see much better results. Okay, now the final one that I wanted to talk about is those that are investing for short-term gain. Now, there's nothing wrong with doing a little bit of trading here and there, but I find that a lot of people lose money when they start trading and getting in and out of trades. Now, the thing is, you are dealing with mostly computers, high frequency trading algorithms. Now, computers can process things much faster than humans, and they're very good at taking retail traders' money. So you might be one of those people that do really well by doing short-term trades. Fantastic. Very happy for you. But the fact is, most retail traders lose money. So that is something that you need to take into account when you're thinking about looking into doing short-term trading or short-term gains as opposed to longer-term gains. Warren Buffett, very famous investor, said the stock market is a device that transfers money from the impatient to the patient. And it's very true. It's very much easier to pick longer term investments that you know are going to pan out as opposed to short daily or weekly moves in a stock price. So that's the 5 type of folks that probably shouldn't be invested in the market. I'd like to hear what your thoughts are on this. Maybe you agree with some, maybe you disagree with some. I'd love to have your comments on this video to see what you guys think. So make sure you like and subscribe to the channel. It really helps to get these videos out to more people. Make sure you get your free stock if you sign up with Stake. I have my referral link in the description. Signing up with that and depositing money means that you'll get yourself a free stock. It's basically free money just by jumping in and signing up with the brokerage. So thank you guys so much for watching this one, and we'll see you later.